You know what I love about investing today in 2020? It's that every single person out there has the opportunity to invest in the stock market. You want to know what I hate about investing in 2020? It's that every single person out there has the opportunity to invest in the stock market. And a lot of newbie traders get started investing, or I should say trading, into stocks and options that they do not have any business trading, and this is what causes them to have an all-time chart of negative 99.98%. And this is what caused this guy to be down 30 grand and have $5 left in his account. Now the funny part is that it's not just limited to newbie stock traders, not just people that got unemployed and are trying to make a quick buck. This also happens to pension funds. MTA pensions decimated by COVID-19 market crash, lawsuit says. And if we keep scrolling further down here into this article, an investment value loss of 97% in a single quarter, the complaint alleges. 97%. So it is not just average traders like this that lose all their account. It is also people in positions of power, people with lots of money. And this is why I do not sell this on my channel. If you look on my channel, I own 25 different companies, all very safe, very conservative dividend paying stocks. And as I scroll through here, if you're new to my channel, you'll probably see a lot of the names that you see and know every single day. I'm sure everybody watching this knows JP Morgan Chase. Everybody knows Visa. Everybody knows Pepsi, Coca-Cola, McDonald's, Home Depot. A lot of these companies are ones that you see every single day. And this is what made them so successful with their branding power, their financials, and their incredible business models. Furthermore, I will never try to sell you on my channel investing ways that will make your chart go to negative 99%. This will never happen with my portfolio because the companies here are so conservative. But as a dividend investor, specifically as a dividend growth investor, how do you address this market? The market's at all-time highs, and as a dividend growth investor, when you're dividend investing, you want the market to be as low as possible because right now investing for yield is pretty much impossible. Right now the dividend yield for the S&P 500 is a whopping 1.5%. Wow, that's like a glorified savings account. So basically the only gains that you're really going to get from this is mostly capital gains. My portfolio currently yields a little bit over 3%, but even 3% isn't really super high in this market. But if we look at this, you see massive outperformance this year for what you would expect it to be. Now, if you look further into this, we're about to go over the unemployment rate, we're about to look at GDP, we're about to look at some other factors as well. But before we dive into all that, if you're not familiar with me, my name is Jordan, I'm a millennial investor, and I update these charts every single month, including my annual and monthly dividend income, as well as my portfolio value and my monthly YouTube income. So these are updated every single month, so go ahead and tune in and subscribe if you want to be a part of that and you want to see how that works. And also, if you want to get signed up with M1 Finance, I have a lot of things down in the description, including mentoring calls, including investing in the 25 companies that I currently own. So if you want to see the portfolio for yourself, that's down there, and other things like Yada savings accounts, credit card referrals, and then most importantly, the brokerage that I use. I think that M1 Finance is the best brokerage for dividend investing, for dividend growth investing. It is a free platform to use, no fees whatsoever. And more importantly, if you use this link that's down in the description, you sign up and deposit $100 to the platform, you will be like the 58 people that we've had to do that so far. You will get a free $10 bill just for getting started. So go ahead and sign up for that. I'd invite you to do so. Thank you guys for tuning in, and let's go ahead and get started. So like I said, we have the S&P 500 at all-time highs. Meanwhile, if we look at this 5-year chart, the outperformance is incredible considering the type of economy that we're in. Let's go ahead and give a little insight into that. So if we look at this, this is the official Bureau of Labor Statistics report, and this was reported just about a week or so ago. And if you look at this, the total non-farm payroll employment rose by 245% in November, and the unemployment rate edged down to 6.7%. So that was good news, is that we edged down. But still, you're looking at about 7% of the entire United States unemployed without a job, which is nowhere near what we were looking at just a year or two ago. You see the unemployment was 4%, 3%, even edging all the way down to almost 2%, which is about as good as you'll ever see it get. And now we're still getting up to numbers at 7% plus. Now, if we look at GDP, I want to go ahead and go to another article here. I want to go ahead and go to GDP. GDP has had a massive downturn. And by massive, I mean the biggest downturn that this country has ever seen, factoring in greater than that of the Great Depression, factoring in greater than that of the Great Recession. Other times as well, this is the worst time that we've ever seen in regards of GDP. There was a little bit of a downturn in quarter one of about 5%, and then quarter two went down over 30%. Over a 30% downturn in quarter two of 2020. Now, the good news is quarter three has been the biggest bounce back we've ever had thanks to the reopen of businesses and the gross domestic product growing at a massive rate. And this number, the real gross domestic product, increased at an annual rate of 33.1% in the third quarter of 2020. Now, that's the good news, but what's really curious here is what's going to happen in quarter four of 2020. What's going to happen in quarter one and quarter two of 2021? Because potentially we're looking at new shutdowns right back into those same restaurants, into those same businesses that we just saw earlier in the year. Now, if that were to happen, that would take these numbers right back down to these levels, and that would take the unemployment numbers back to sky-high levels where it was back here at the beginning of the year at 14, 15%. Now, this is not what I want. I'm not a fan of shutdowns. Me personally, I know a lot of people are in fan of the shutdowns. I'm not whatsoever. That's just my opinion. But regardless, I don't think that this is going to be good for the economy or the GDP coming up. But meanwhile, when you have this, you have all these bad data. You have the bad GDP, you have coronavirus cases rising, you have unemployment still at pretty high levels compared to where we were just a year or two ago. But look at the stock market, well past its all-time highs. At the beginning of 2020, you see that it was about $320 a share, the ETF, the SPDR ETF. Today it's at $370, a massive uproar considering our economy is not reflecting that in the market. And part of that is due to a number of different reasons. I won't get into that now, but basically it's due to Fed making easy, accessible money. It's due to big money buying the dip and a lot of retail traders doing so as well. And then basically when you have a recipe like this that really looks like a bubble, it just might be. I'm not going to predict a stock market crash, and I'm not going to say it's going to come anytime soon. It might not come for 10 years from now. I have no clue. But what I really hate about this is that investing in pretty much anything right now, you're not getting the value for your money that you could have 6 months ago, a year ago, 2 years ago, or really any other time in history because we're at such sky-high valuations. This is not what I like to see whatsoever. Now, if we keep on going further, I want to show you another thing. Black Friday shopping in stores craters 52% during pandemic as e-commerce sales surge. Now, this just shows one more way that we are focused on technology and that we're focused on these big tech companies rather than just looking at the overall market. These tech companies are beginning to make up a massive percentage of the SPDR ETF. Specifically, actually, you know what? Let's go ahead and research. Let's go ahead and hit stocks, and let's look at the top companies. Do you notice a trend here? These are almost all tech companies. We have Apple, we have Microsoft, we have Amazon, Google, Alibaba, Facebook, Tesla. These are the type of companies, which by the way, it's crazy to think that Tesla is among the top companies out there, worth more than freaking Berkshire Hathaway. Guys, I've mentioned this before. I'm a Tesla fanboy. I got you. But $600 billion? Sell the stock already. But these companies are some of the largest tech companies in the world, and that is what is creating a bit of a bubble for the rest of the market. And that is why these regular stores, your traditional brick and mortar stores, are having sales decline 52%. 52% during Black Friday. And another thing about this that is really telling here is that when you see companies like this going to sky-high valuations that do not deserve it whatsoever, when you see companies that are trading at valuations that are so far into the future that it's just absolutely unrealistic. I'm going to go ahead and flash some names up here as I talk about this. But when you look at these type of companies, it's interesting because you see a lot of fraudulent companies temporarily get to levels where they never should get. Nikola. Nikola is a company that I previously made a video about, and I said that the company was just flat out a scam. I said that they're going nowhere, they're going to zero. I'm still holding my price target. Here, I'm going to be a professional analyst real quick. You ready for this? I have a price target for Nikola. Would you like to know what Nikola price target is for the Jordan Ball investing firm? I have a price target on Nikola of $0 a share. When this company goes to zero, maybe I'll buy one of their Badger trucks if they ever produce one. But that said, Nikola shares crater by 27% after GM gives up early equity stake in smaller reworked deal. If we go to Nikola here, let's look at Nikola stock. This is why investors are investing into companies that they know nothing about. And that's the same thing why I want to relate to a company like Tesla. Let's look at the overall chart since this company went public. It skyrocketed in valuation to $80+ a share. At one point, when this company was worth more than $80 a share, it was also worth more than Ford Motor Company. Ford, you know, the company that's been around for hundreds of years, one of the most powerful companies in the automobile industry. Yeah, we're talking about Ford. This company that has not produced a vehicle yet, but because they put electric in front of it, was worth more than Ford. And today, while it was $80 a share just earlier this year, today it's under $20, and I couldn't be happier. I'll be celebrating when this company goes down to $1 a share. That's what I'm ready for. But GM finally realized that this company is going to zero. And one of the things that's interesting about Nikola, one of the reasons why I think that this really ramps up the negative impact of this company, is that one of the only things that made this company legitimate was the fact that they had the GM deal. Now that that's off the table, now that the company is no longer taking a stake in Nikola, I think that this company is absolutely on a race to zero, and it could happen within the next 1 to 2 years. I believe so. I don't recommend shorting stocks, but if you want to, there you go. There's your company to look at. And then one more thing I want to show. I found an article here on MarketWatch yesterday that said 1 in 10 employers have used COVID-19 to end their 401k match. So furthermore, not only do you get to buy companies at a much higher valuation, you get to pick up far less shares than what you could have 6 months ago, a year ago. So it is much harder to invest for your retirement when things are at sky-high valuations and theoretically in a bubble. But furthermore, about 10% of all employers are ending their 401k match, making it harder for people to save and invest for their retirement. Now, it doesn't matter what you're investing in, it doesn't matter what your retirement's for, but obviously a dollar for dollar match doubles up your retirement instantly the moment you put it in there. But if 1 out of 10 employers are cutting that back, that means it is harder for people to save and invest for retirement. Now, I want to go ahead and give a quote from Jim Cramer here that I think described it perfectly. Now, like I said, I'm not a fan of Jim Cramer, but some of the reasons why I love him is that I love using some of his quotes because the things that he says is just, it's sometimes ridiculous. So it's really quote worthy, I guess you could call him. But Jim Cramer says that young investors, quote, change the entire character of the market. And I have to say, I 100% agree. I think it's time to start disrespecting the younger investors who nailed 2020 every step of the way and start taking them seriously. We've got a massive group of individual investors who become, in many ways, a more collective, powerful force than professionals, and they simply don't care about the same things as the experts. The return of individual investors has changed the entire character of the market. I could not agree more. And that is what causes these bubbles. That is what causes valuations that are at levels that are absolutely absurd. When you look at companies like Tesla, for example, people are so bullish on Tesla that they think that it's going to be the #1 company in the world. Now, guess what? You guys have done really good so far. I was betting on Tesla when this company was $100 billion, when this company was $200 billion, maybe even all the way up to $300 billion. But now we're looking at a company that is almost the most valuable company on planet Earth, and at the end of the day, they are not anywhere near the levels where they need to be at a $600 billion plus position. And this is now, like I said, just to mention, in case you guys forgot, remember the great almighty Warren Buffett? It is now worth more than his company, Berkshire Hathaway. You heard me right. It is worth more than Berkshire Hathaway. That is incredible. That is insane. And that is why these younger investors has completely changed the entire character of the market. Now, all that said, now that we got through all those articles, I want to go ahead and close all this out, and I just want to give you a quick opinion about how I feel about this market and why I think it is absolutely absurd to be investing in a lot of these very extreme high growth names. While I know it's fun, while I know you see returns that are absolutely sky high, next level returns, what happens when this streak eventually ends? I think a lot of people are going to get wiped out. Think about how many people, when they're investing, let's just take a big name, okay? Let's take a high growth tech name like an Apple, for example. How many people during this year chart, when this big dip happened, when you were buying at $80 a share, it went down to the 50s and you sold out in a panic? What happens when you're investing in, say, something like a Shopify, for example, and a big dip happens and then you inevitably sell out? It goes from 500 down to the low 300s. That is a big dip, and I think a lot of people are emotionally not prepared for this next downturn. Because guess what? I can't tell you when a downturn is going to happen in the market, but I can guarantee you one thing. A correction in the stock market is long overdue. Now, I didn't say a crash, but a correction. Stock valuations of all sectors need to come down. This is not healthy. We are not at levels that is sustainable, and I would love to see a downturn in the market so I could pick up shares at a better valuation. But thank you guys for watching all the way to the end. I'd invite you to subscribe if you haven't done so already so you can watch me update these charts every single month. Go ahead and check out the description down below, like I said, involving Yada savings accounts, credit card referrals, my portfolio, and M1 Finance referrals so you can get $10 for signing up. But thank you guys so much for watching. I'll catch you guys next time.